Portfolio Builder members, welcome to our Friday Trade Alert where we're playing the SPY ETF. Today we'll start off with the topical news so you have an idea of why we're pointing our trades in the current direction. And then we'll take a look at the track record and what we're forecasting for next week. So the big deal is twofold. Number one, looks like Trump's advisors have decided it's time to pull back the pressure on China and focus on the 2020 election, as well as trying to get all this impeachment talk died down. And so there was a supposed meeting with all the trade advisors where they pushed Trump to go ahead and try to create some deal last Friday, in which our trade advisors continue to report rosy outlooks. And so if this is the case, the rumor coming from China is that they're going to demand all tariffs removed in order to pick up this $40 to $50 billion a year of agricultural purchases. They're going to want their CFO from Huawei released, which is the CEO's daughter. And so if those two things were to really occur, I think stock market would fly up, because on top of that we have all the central banks lowering interest rates and printing. White House advisor Navarro says we plan to have a deal by the APEC summit in November. And overnight, the GDP from China hit 6%. Expected was 6.1. Even if they're overestimating their GDP 2 times, they would still have twice the GDP of the USA. Which is why everybody wants to get their money over there in the emerging markets. China and the U.S. are now clearly weakening. Another round of tariffs will bring the prospects of a material slowdown even closer. Given mutual benefit, the odds of some meaningful detente continue to increase. Just don't expect the non-economic feather ruffling to slow. Fed Kaplan says global growth is deaccelerating, cites trade tensions. Oh, nothing to do with China's record debt, which prevents Beijing from injecting a few trillion in debt to boost its credit impulse. Fed's Kashkari expects inflation to undershoot the 2% target for the foreseeable future. Here's a photo from Bloomberg. China's economy slows on weak investment, testing global growth. China's gross domestic product rose 6% in the 3 months to September, and this is while U.S. was at 1.5, the slowest pace since the early 1990s, and below consensus forecasts. A slowdown in investment was the main driver for lower than expected number. Investors are looking to a meeting of the Communist Party top leadership due in the coming days for a possible review of stimulus measures. There is a feeling, however, that the officials are allowing growth to run a little slower as they seek to clean up the financial system and deal with excess leverage. Here is an interesting chart I found. Those blue dots up top are the most important to look at. This is when we've had massive rallies in the stock market. And my expectation is, now that we have $200 billion freed up on the bank balance sheets, and that's about to get much larger. This is from the Fed buying treasuries straight from the banks, freeing up their cash. The next move, I believe, will be a trade deal and a big blue tick. That's $40 million plus, which could send stocks flying. And again, my target for the SPY is in that 315 to 330 range, which is around a 10% return on the SPY. And in emerging markets, just to get back to the 2017 high, we have a 20% potential gain. And so this is after we've been dealing with trade war all year. Equities have risen and delivered some profits in our portfolio, but the majority of our profits have been from the TLT. So are the tides turning? I suspect so, because we've created enough of a downturn to ignite quantitative easing, which trumps all other economic indicators. When the banks get to unload trillions of dollars of bonds for a huge profit that they could never sell into the open market, and have a fresh balance sheet to jump into equities. At the same time, all tariffs are removed and a trade deal is striked. That's going to potentially send these stocks up much quicker than I believe many people predict. And I love to be negative Nancy. I just don't see it in the cards to be short U.S. equities at this point. Not without a major catalyst, and of course that catalyst would be a Trump tweet where he's clearly getting upset and reversing course on this trade deal. So until then, our strategy remains intact, and we'll look at our exact allocation in a minute. In Q2, the S&P 500 companies spent more than 100% of their free cash flow on stock buybacks and dividends. The last time they did this, just before the financial crisis. This time's a lot different, though. They've been doing this level of buybacks pretty much for the last decade. And until this little circle loop of free credit and stock buybacks is broken, it's going to be very hard to have a significant pullback in stocks, as the corporations and central banks around the world are the primary buyers, especially in the last several years. This was big. Zuckerberg had a big speech at Georgetown yesterday, and he has officially, if you read between the lines, he has jumped ship. He is now an avid Trump supporter. Now, of course, he's not blatantly saying that, but if you do listen to his speech in Georgetown, he critiqued all of the social network platforms who are censoring different viewpoints. It was a beautiful speech, made a whole lot of sense. And his main point was that it's not Facebook's job to judge content, especially political. They will block anything that is harmful to people, and they will block people who don't have a government ID, which is now required for Facebook. But what they're not going to do is act as the judge as to whether content is truthful or not. He's going to let the audience figure that out, and if you don't like what someone's saying about you, you can go use the court system to sue them. So this is totally different than what Google, Twitter, and most of these tech companies are doing. And it's at the same time that Zuckerberg's trying to push his Libra project through. So it does seem that he is clearly aligning with Trump, as Elizabeth Warren wants to break up his company, and there's been little leaks that he is ready to go to battle with Warren, and also sees her policies as an existential threat to Facebook. So that's a good move for the Republicans, for free speech. It was a great presentation. I'm not normally a huge fan of Zuckerberg, but you got to keep in mind he has something like twice the eyeballs as Google does. The only company in the world that's even close to them in terms of eyeballs is some Chinese app called TikTok, which is used by little kids primarily to do little funny video clips. It's not a platform where you have adults using it daily like Facebook to the tune of some 2 billion users. So let's see what Warren had to say about his speech. And again, this is a huge change in the tech world, and might be the beginning of a pattern. We'll see. Mark Zuckerberg's speech today shows how little he learned from 2016 and how unprepared Facebook is to handle the 2020 election. Zuckerberg, in flaming debate, asserts Facebook's stand for free expression. Here he is with the American flag behind him over at Georgetown giving the speech. Tech world is going to be outraged, and this is very, very interesting. Here's the thing, Mark. Trump isn't just posting a lie on his own page for his own followers. Facebook is accepting millions of dollars from Trump to run political ads, including ones with misinformation and outright lies. Ads that TV stations won't even run. Facebook is actively helping Trump spread lies and misinformation. Facebook already helped elect Donald Trump once. They might do it again and profit of it. If you listen to the podcaster on YouTube, Raven of the Quoth, he had a great interview with John McAfee, who's one wild guy. He's actually running for president. Apparently he's gotten on a ship, put all his money into Bitcoin, and is trying to avoid taxes. He's trying to get, the guy's a character, interesting interview. But he wanted to point out that something like 6 million of the 21 million Bitcoins have been lost forever. So there's this limited supply. We have a general phase where the central banks are printing money, governments are going into debt. An IMF guy came on yesterday, $288 trillion of debt out there. It is absolutely insanity. And so the more money that's printed, slowly but surely, the more valuable assets like Bitcoin, gold, etc. will go up in value. So I like having 1% of our total portfolio in Bitcoin and Ethereum. Here's a look at agricultural purchases since the trade war. In 2012 and 2013, they're purchasing almost $30 billion. And then that's when they had their first major slowdown, where they almost collapsed the whole global economy. And they came out with the wonderful idea of the Belt and Road Project. This is after they'd built city after city the size of New York, where no one lives in it. And mansion houses all over the place. That's how they've kept this huge GDP, as they're great builders, perhaps, although a lot of the buildings are done poorly and starting to crumble only 5 to 10 years later. But we'll see if they can get to $40 to $50 billion a year, ramped up over the next 24 months is the rumored timeline, then that will be significant, at least for the farmers. And so is Trump going to throw the tariffs out the window, take a trade deal, let the stock market and Wall Street have a little party? It's looking like that may be the case. This will upset a lot, but will it be the better move for his 2020 election? Seems to be the way it's rolling right now. China secretly ordered NBA commissioner to fire Rockets general manager over the Hong Kong tweet. Meanwhile, WeWork could send a ripple through the real estate markets. Their valuation went from something crazy like $60 billion to, I believe, $8 billion. And now they're trying to get a $6 to $8 billion loan at an interest rate of something like 8% or 10%. So this is something we've been following. Perhaps it's tied into some of this repo madness. Not very clear what exactly is causing the repo madness, because the central banks do not allow us to see that. If we could see which banks are in trouble, then guess what? All those medium-sized hedge funds out there would be attacking those banks aggressively and further increasing the problem. So that's the reasoning behind why they keep that all top secret. White House trade advisor, this is from the Chinese Communist Twitter handle. White House trade advisor Peter Navarro quoted a fictitious anti-China economist Ron Vara in several of his books, including Death by China, Confronting the Dragon. This is shameless fabrication. Navarro cheated his readers. Who knows if he misled the president? So unclear why that nasty comment came out. Here's a look at our top charts that are involved in our strategy. SPY ETF has been dying to get over this 300 level. And what does it need? It needs the tariffs to be removed. It needs trade uncertainty to come off the table. And it needs some good old-fashioned quantitative easing. Now remember, normally the Fed has been pretty good at predicting a recession, and they start to drop interest rates ahead of it. And the last two bubbles we've all lived through were primarily created here in the U.S. We had, at least in terms of the 08 and the dot-com bubble. Now we've seen China almost blow up the whole system several times in the last decade, but they've saved the day with massive stimulus. This time around, it's clearly China's slowing growth that's causing all the trouble, and our Fed is not only dropping rates, but starting up QE. So this is not normal. Usually they do the rates as the market crashes, then they do the QE after we've seen a 30 to 50% crash. So this time around, I think they're realizing they can't drop rates as much as they have in the past. Typically they drop it 5% to save the day, although that never saves the day. It's not until the QE comes in that markets do rebound. So it's quite curious that they are jumping the gun, trying to prevent a recession before it's begun. And this will put us in a position where we have absolutely no ammunition from the Fed. So if they do this and it doesn't work, and we're at 0% interest and expanding the balance sheet, and then inflation comes ripping in, well, we're going to have a very, very difficult market to play if you're just buying stocks and hoping for the best. Now, with our program, as we talk about consistently, we would actually make a lot more money than we do in this sort of environment. So LQD is the investment grade corporate bond ETF. This is a good way to measure what the interest rates are for corporations in the top part of the SPY. So we're talking like Microsoft, Apple, the big dogs, Amazon, Google, even GE, for whatever reasons in this basket, and one of the biggest borrowers actually. But as long as this is elevated, they essentially have access to extremely, extremely cheap credit. And they're taking that credit and they're buying their own stocks. So unless you have a serious catalyst to really put fear in the masses, it's going to be very, very hard to scare people out of U.S. equities. Not only do we have QE, not only do we have corporate buybacks, not only do we have rates from the Fed that are dropping, potentially 25 basis points in October and another 25 in December, we also have the hope that there may be the removal of these tariffs. So this is all looking like a huge breakout in equities. Here's the TLT. This has been the biggest moneymaker for us all year. We had our second losing month out of the last 11 this month, so far at least, on the TLT, and we remain long. The big catch is if the trade deal breaks down, and there's a million reasons why that could happen, then this TLT is primed to go up much higher. We have the Fed buying treasuries, controlling the rates, number one. Two, we have massive QE coming through. So the banks will have fresh balance sheet. They'll decide, is it heavier in stocks or bonds they want to load up on? And that'll most likely be determined by the outcome of this trade deal. Meanwhile, U.S. earnings remain strong. Unemployment's strong. Inflation is below 2. So meanwhile, in emerging markets, we're up considerably. This portfolio has had a nice rise this week already. And again, to get to the most recent high in 2017, this will trade to 52. That's about a 20% rise from here. And again, all of this is lining up perfectly if we get a trade deal. If we don't, then remember, we have 40% of our portfolio in the TLT, or rather 30%, and then 12% in gold. So we have good protection to the downside on top of our put options on the SPY. Here's a look at GDX, the gold miner ETF. There's three things we look for to be long gold. Gold doesn't like to stay at a certain price for very long. It either likes to travel up or travel down. That's because it doesn't generate profits. It's really just a fear product when central banks are being reckless, which they are doing right now. So we got number one, we got QE. Two, we got lowering rates. The last thing we need is a little bit of fear. So we remain long GDX. Crypto is having a little bit of a sell-off today, but again, for all of these reasons, we play it the same way we play gold. Instead of having 10% in gold, I actually have 8% in GDX, 1% in Bitcoin, and 1% in Ethereum. And these crypto coins have treated us very well this year. As we got into Bitcoin around 3,500 and Ethereum around 90. Dollar has been softening due to all the central bank policies, and this is again showing support for emerging markets as the dollar softens. Another reason we want to have that EEM ETF in our portfolio. This is a play we've been waiting to jump on, which would profit from an increase in tariffs. So you can see the Chinese CNH against the dollar has been devaluing all year, and if we use the futures market, every 10 cents this goes up higher is $1,000 profit per contract. So currently, we're on hold to put on this play. We need to see if this trade deal really occurs. And if it does, I'd suspect this exchange rate could drop back towards that 6.8 level where it was back in July. So if that happens and a trade deal is on the table, we would wait for phase 2 to look like it's having signs of trouble before trying to short their currency. Now, in the long run, the chances of a serious deal do seem quite unlikely, and that's because it would take away the bulk of Chinese competitive advantage. And if you think about companies like Huawei, which are now the biggest seller of phones in the world, bigger than all of its competitors almost combined, and that's because they go and sell phones at a loss and subsidize those losses from all the tax revenues from all of China's other industries. So what's the effect of that? Well, they can put their competitors out of business. And so unless they want to stop behavior like that, as well as sending people all over the world to steal technology and bring it back, I think we're going to have a long-term conflict with China. As far as the bond market, German yield is still in negative territory. That 30-year has popped above zero for a little bit. And so this just gives us a picture of where U.S. yields could head towards. So I think there's plenty of room for them to go a bit lower if any kind of trade friction occurs. But in the same breath, I don't think it'll travel much higher because we have, again, the massive Fed purchases of bonds, which will help control downside risks on our TLT. Gold sticking in there at that 1500 level, which is good for the miners, which were long with GDX. Unless we get some sort of surprise in October where they do not drop rates or they don't do this huge QE package that we're all expecting, which should be around $300 to $500 billion one-time injection to the balance sheet. They're going to go buy up all these bonds. We want to remain long gold during this period of time. Okay, let's take a look at today's trade alert and our track record. And welcome, Ron. Good afternoon. Thanks for coming into the chat. We got quite a few people watching live. If you want to say hi, please do in the chat box. Okay, so the headline today on our email was collect $5,000 over the weekend. Let me explain how that is possible with the SPY ETF. This trade has the potential to make $1.48 a share, and in our portfolio, this is 3,700 shares. So to get that maximum profit, we would need the SPY to trade above 350 cents on Monday. Now, we don't care how much above it goes because we get cut off on the maximum profit once it goes above 350. Now, in the same breath, we have a lot of downside protection on this trade, which we'll take a look at. The previous trade was pretty much a break even. The SPY traded up 4 cents. Our option caller lost 10 cents, so we lost 6 cents a share. TLT creeped up a little bit, so our portfolio did go up about 10 basis points from yesterday through today. We did a good job reviewing the key news, so I'll skip that. Here's a look at our asset allocation. So you can see I currently have 37% of the total assets in the SPY, trading Monday, Wednesday, Friday, about 11% on the Tuesday trade following the emerging market. Hey Oscar, thanks for saying hi in the chat box. We have a 10% allocation in gold, although I have broken off 2% of that into Bitcoin and Ethereum. And then we have a nice heavy 40% position in the TLT, which again, I believe has very limited downside risk at this point and still has tremendous upside potential in case anything goes wrong in the trade war. We started off October with a 1.1% return, primarily from the TLT with all this fear about the trade deal. And then we had to give most of that back when Friday came around and they announced we are going to move forward with this phase 1 trade deal. So that was a surprise and not something I expected. You'll always see in our program, we will expect the worst and plan for that and miss out on surprises to the upside. I'd much rather be protective and precautious and work with the facts we have in hand versus try to predict what might come in the future that has not. So right now the facts are that the trade advisors are saying they will make a trade deal by November. The Fed is on track to release $300 to $500 billion of quantitative easing, and they're lowering interest rates. So we have to be long the SPY in these market conditions without some sort of downside catalyst. Here's a text message you got to get out of last Wednesday's trade, buy to close your October 18th. Here's a screenshot actually how to do it. So buy to close. This is again if you took last week's trade. If you're just getting started, you'll skip to step 2. Buy to close the October 18, 2019 301 call for a penny, and then sell to close your 296 put for 4 cents. Today's new trade is a relatively tight collar, although if we can make anywhere near the potential $1.40 profit 3 times a week, 52 weeks a year, that turns into a huge return. In fact, we try to simply average 25 cents profit 3 times a week to get our target 1% a month. So this is actually 5 times, or rather 6 times the return we would actually need to achieve our 1% month target. So we're selling the 350 call, which just means we will sell our shares for $300.50 plus keep that 26 cent premium if the SPY goes significantly above 300. Chances of being exercised between now and Monday are very slim, but if we were, all that would happen is we get sold. We get to sell our shares for $350 a share, keep the 26 cents, and walk away with the maximum profit. Monday, you're back in cash, and you can repeat the trade on Monday. Now, on the flip side, we've bought a relatively juicy put option at 49 cents. Debit at the 297.50 strike. So if the SPY were to crash this weekend because who knows what, Hong Kong protest, China-U.S. trade talks breakdown, there's a number of things that could occur. This would get us $297.50 minimum price for every share of SPY we have because the put option would go up in value as the SPY went down. So let's look at our risk chart. We have the potential to profit $1.48, and we have the potential to lose $1.52. And you got to keep in mind, this is also with our exposure to the TLT and to GDX. So if the market were to break down significantly, the further the SPY crashed would be the better for us because our put option would come into play, and the TLT, which we have twice as many shares of, would most likely generate an overall profit for our portfolio. And so if we do go back to our track record, you can see that's exactly what happens often in our strategy. Look at August when tariffs were raised. That hit us completely off guard, and we made 1.8% thanks to the TLT. Go back to May. There was no real catalyst. People are taking profits after a huge run-up in stocks all year. TLT provided a huge gain as stocks crashed. Our put option kicked in. We made 2.2%. S&P 500 was down 5% that period. Now in December, we made 1.2%, again thanks to the TLT. But guess what? Stocks were down some 10% that month. Now, did we get killed when the market suddenly turned around in January and flew up thanks to the central banks coming in with a bunch of cash? No, we made 2.2%. So the strategy is very hard to lose, and it's because of this balance of stocks to bonds. And so here's a quick little piece about our program for everybody listening, as well as a special offer we have for new people considering joining. Target daily income trade alerts at noon Eastern. This is Monday through Friday. Very predictable trades that you can easily follow Whether you're at your house, in the airport, at a restaurant, these trades take just a minute to place, and our clients tell us they do this all over the place, at restaurants, in the airport, on the plane, you name it. Our target return of investment is 1% a month, and we've only had one losing month of negative 1% with an average return of 1.5. Here's our current trade allocation. It's heavy in equities with a 48% stock position, slightly overweight, predicting, as we said, upside potential in equities in the current environment. 40% bonds, that's our insurance policy in case anything goes wrong at this point, as well as 12% in gold with the same concept as bonds, just a much more volatile product. Target income is $750 a month per $75,000. With our average, you'd be making closer to $1,000 with the past results. Now, of course, the future is not indicative of the past. The SPY is traded Monday, Wednesday, Friday, and takes advantage of 3 option expirations a week. Emerging Markets ETF, we trade on Tuesdays, taking advantage of weekly options. And the TLT we trade on Thursday. Keep in mind there's a 2-to-1 ratio of the TLT to the SPY. And that's because the TLT costs about 1/2 the value of the SPY. This allows the SPY to crash unexpectedly, our put option kicks in, and then the TLT generates a big profit. And that's when we get caught off guard with the stock market. Now, on the other hand, if the stocks just keep climbing up, I see very little downside risk in the TLT while we have the Fed dropping interest rates, which will pull these yields lower, and also purchasing up massive amounts of bonds from the bankers. So it's a great setup. It's hard to lose. Our simple 4 ETF portfolio is extremely diversified and all you'll need for your retirement. Just keep in mind the SPY has 500 companies. The Emerging Markets ETF has 1,000 and GDX has 50. So you are extremely diversified in the most important equities markets, which is the US and Asia. As far as gold miners go, you have the best positions in the biggest companies that actually make money, not just IR companies doing penny stock scams. So our program is all about income and safety, not growth or speculation. It's time to simplify your holdings, reduce your risk, get better results with less work, and weatherproof your retirement portfolio. For every $300,000 invested, our goal is to generate a $3,000 per month profit. If you look in the description box, which is right down here, you can apply for our advisory or call Dean to get a special deal. Here's a summary of what's included. Easy to follow daily income trade alerts every Monday through Friday at noon Eastern via email and text, followed up by a 1-hour daily video teaching you how to place the trades. Plus, you have a live chat box. If you have any questions, you can communicate with me live immediately after the trade alert is released. An optional spreadsheet just like ours to track your results with tutorials on how to use it. And the promise to protect your portfolio, pick up the low-hanging fruit, and target a return of 1% per month with very little risk to the downside. Also, we offer a 16-week retirement income boot camp. This boot camp repeats itself 3 times a year, and you get to take it as many times as you like. This turns you into an options trading machine that can print safe profits out of the stock and bond market. Mainly, it's just a webinar every Tuesday where we take you through all the things you need to know to follow the program, including how to place the trades. And in this boot camp, we're not just going to catch the fish for you. We're going to teach you the whole strategy so you can do it all on your own. If you call Dean at 505-322-7515, we have a special Friday-only lifetime deal where you get lifetime access to the boot camp and advisory for a one-time payment. So if you want to save money in the long run, call Dean, take advantage of our Friday special. And again, that's 505-322-7515. All right, guys, thank you so much for your time today. we'll be closing out this SPY trade come Monday and following the same schedule next week. So hope everyone has a great weekend. Is there any questions from our live group before I close out today's live stream? And Oscar, thanks for joining us. How's it going, Oscar? The men, the myths, and the legends. Definitely try to check out that Georgetown Zuckerberg speech. That is pivotal. This is a pivotal moment in the tech industry where it looks like people are starting to jump ship from their old home base, which is big, very big. Thank you, Victor. All right, guys, thank you so much, and keep a lookout for you're going to get your webinar replay if you're on the free trial Saturday, and if you're a paid member, you should have got it yesterday. Looks like we had a huge open rate and click rate on that one, so I hope you guys enjoyed that. Ron, thank you, and we'll see you on Monday. Thanks.